This year's talk is about investing in crypto assets, so I'll focus more on the financial side of things. But nevertheless, if you're interested in the technical background of a blockchain, how consensus can be achieved in a decentralized system and all that stuff, you can check out my website, betz-crypto.com, because I've uploaded last year's recording there. And now, before we begin, there's a little disclaimer that I need to make. So this talk is no financial advice. I only share my own opinion. This is also no solicitation to buy any of the crypto tokens that I talk about. Now, let me run through the outline real quick. So I will introduce myself. Then I want to share some essential investment basics with you that are also applicable for the crypto market. After that, we'll focus on crypto investing. So I will tell you how I do fundamental analysis on crypto token, how you can evaluate them. And then I have 3 examples of investment styles that are used in the crypto world. A few words about me. So I'm Jonas. I did my bachelor's here at the THWS. I wrote my bachelor's thesis about how to structure a crypto portfolio according to the modern portfolio theory. After that, I started my master's and I had the opportunity to work at F5 Crypto Capital. This is a German crypto fund for institutional investors. My job there was to research and evaluate crypto investment opportunities. Now I'm currently finishing my master's degree. And I also have my own joint now, so betz-crypto.com. This is where I upload some articles and fundamental analysis. Before we talk about crypto, I want to share some basics with you that are applicable in the traditional markets, but also in the crypto markets. And there are 3 topics here. So the first one is financial literacy. But I guess who am I talking to? Of course, you all have financial literacy. You probably had a lecture where you were taught about the time value of money, about diversification effects, about the interest rate, about compounding effects and all that. But there's another thing that I also account to financial literacy. It is that you have a general overview of what are your goals that you want to achieve, what is your time frame, what is your risk to reward level that you're comfortable with, and then structure your or start your journey from there. And also, what you don't want to do is invest some here and some money there and don't have a real overview and a real plan. And it is important to stick to that plan because I'm sure many people have already told you to have a plan and all that stuff, but you should actually do it and stick to it and don't deviate from your plan if you're then in the moment and your emotions tell you otherwise. Next up, there is the economic and common sense. And you might ask yourself, why do I need economic sense for crypto investing? So aren't the crypto markets and cryptos in general something that is totally different from the economy? And actually not anymore, because studies have shown that the correlation between crypto assets and equities have increased in the past few years. And this is most likely due to the influx of institutional investors. And that's why classical economic principles, like for example, the market cycle, also apply to the crypto market. And I really want to stress the market cycle here. I'm sure all of you know about that. But in investing, timing is key. And you want to have some general idea of the market cycle, because the crypto markets, they are very cyclical. If you look at the Bitcoin price, for example, you see a cycle every 4 years on average. The idea here obviously is that you do not buy in at the distribution phase and do not sell in the accumulation phase. If you want to know more about market cycles in general, there's also an article about that on my website. Next up, we have the macroeconomic developments, and they also affect the crypto markets as well, because there are so many institutional investors there. So if the inflation rate rises, if interest rate rise, or the money supplies increase, you can also feel those effects on the crypto market. And lastly, a thing that the crypto market or crypto assets are very prone to are market bubbles. If you read a little bit about market bubbles and have some common sense, then you will be able to spot those. I really want to stress that you have to use your common sense when you invest in crypto assets, because if something seems to be too good to be true, then it mostly is. And I've brought an example for you here about safe returns. Generally, there are no safe returns above the baseline interest rates. This is just a thing that is not possible. But especially last year, investors confused investment opportunity in crypto with being a safe return. And that is the stablecoin UST. I don't know if you have heard of it, but the stablecoin promised an annual percentage yield of almost 20% when staked. And a lot of investors confused this and thought, well, this is a safe return as the coin is supposed to be stable, so it's pegged to $1. And you, on top of that, you get 20% annually. Well, in the end, it turned out that this investment was not very safe, as the stablecoin famously imploded, fell to a value of below 1 cent, and many investors lost their money there. And all in all, there were about $18 billion in investor funds that were wiped out when this stablecoin imploded. Another part where you have to use your common sense is for these trading bots. They might be algorithmic or AI. Most of the times they are a scam if they promise you returns or safe returns. Because think of it like that. If someone created such a trading bot that can guarantee you a profit, this would basically work like a money printer. And who would give a money printer away? I guess no one. And there's an example from real life. So someone came up to me and asked me about this website, Bitcoin 360 AI, if it is legit or not. And if you Google, you find different opinions about this website. And I took a look at it. And I think with some common sense, it could be quickly deciphered that this website is most probably a scam. Why? Because the website is loaded with buzzwords, but no real content. You can already see by scrolling through that it's very SEO optimized to buzzwords. I mean, it's called Bitcoin 360 AI. I don't even know what that means. So, yeah, and also the biggest clue is when you look at the team section, and they supposedly have a great product and a great team, but no one is owning up to it with their names. So that is something where you can see if a project or a website is a bit scammy. The next thing I want to talk about is probably the most difficult thing in investing, and is especially difficult in crypto investing, to control your emotions and biases. And I have to admit that in the beginning, I fell for all of those, and that's why I want to share them with you. And it all starts with the overconfidence and the greed. It's when the markets go up and you make some return on your investments, and then you think, oh, I'm just such a good investor, like young Warren Buffett, but it leads you to not doing thorough research anymore. And also, overconfidence leads to greed, and then you do not realize your profits because you think, well, tomorrow the asset price will rise more. And here's a little rule of thumb that I can give you. When you're about to screenshot your profits on your portfolio, should rather realize them and not wait till they turn into losses again, as the crypto markets are very cyclical. Next up is the herd mentality. That is, if you hear about people investing into this and that thing, and you just think, well, if they all invest in that, they must know something that I don't know. And why shouldn't I also invest and profit from that? And this is called fear of missing out. You don't want to miss out on potential gains that others are making in the market. But if you follow herd mentality, you, again, do not research your investments properly. And more often than not, this leads to bad investments. After that, we have the confirmation bias. This is a pitfall that arises when you start to like a project very much. So maybe you share the vision of it, or you're just astonished by the project's technology. And that leads you to only seek out information that are confirming your beliefs. And actually, you should do the opposite. You should always look at the people who are saying this project is bad because of the following reasons, and don't just blend it out. And also change your point of view if you're presented with new information. And lastly, there's the availability bias, and this just goes back to you putting in work and effort when researching an investment, because the information that is readily available and that everyone has is more or less worthless as it is already priced in. And what you should rather do is dig real deep to find that piece of information that other investors don't know about. And this is how you get an edge in investing. Now let's get down to business. Let me talk about crypto investing. A few words about the crypto market first. I always like to compare the crypto market to the stock market, but on steroids. Why? Because the crypto market moves at a very fast pace. It is open 24/7, 7 days a week, and 365 days a year. So you can never catch a break from the crypto market. And the volatility of the crypto market or crypto assets is much higher than in the traditional market. And this is also why I stress the part about the emotions, because prices, they rise and fall faster and harder. And honestly, big parts of the crypto market are solely devoted to gambling. And later on, I'll have an example where you can really see this gambling part in the crypto markets. And another thing is, I like to say, is the crypto market is like the Wild West, because currently there are no regulations for actors in the crypto market. And last year there was the famous example of FTX, the cryptocurrency exchange, that went bankrupt because they mismanaged customer funds. They used those customer funds to gamble and do all kinds of weird stuff with them. And in the end, it were the customers of that crypto exchange that had to bear the losses. And this is only possible because actors in the crypto ecosystem are not yet regulated. And additionally, there are no safeguards and no bailouts. So, for example, if in the traditional finance world, a bank or something loses customer funds, then the government would step in to bail out the customers, if you've seen that in recent months. But in the crypto market, no one cares. You are on your own, and as there is no regulation yet. But there are currently governments all around the world drafting up crypto regulation. This is a good thing. For example, there are the MiCA rules that the European Union are drafting up right now. So we're really looking forward to some regulation in the crypto market to make the space a bit safer. Okay, so before I dive into explaining to you how to evaluate a crypto token, I want to give you a quick overview about the crypto world and its actors and the relationships between them. And I've brought a little illustration here, and don't worry if it looks complex at the beginning, we'll go through it step by step. So we start off with the developers. Those are the individuals who write the code for a blockchain or an application on that blockchain. And to do so, they usually need some funding. So they go to the seed investors, who are most of the time institutional investors, to get some money to start their work. And then when they have created the blockchain application, the blockchain or the application, then comes the fun part, because they have some tokens now and they want to distribute them. And usually these tokens get allocated to the developers. Of course, they are the ones who put in the time and the effort. And some go to the foundation. The foundation is an organization that is overseeing the long-term development of this application or blockchain. Then the institutional investors want to get their share. Obviously, they invested very early and want to have some returns on their profits. And then also tokens get distributed to the community, like early adopters and users. And I think very famous, but I don't know if it's also famous to you, but there was the Arbitrum airdrop, for example, that distributed the Arbitrum token to early adopters. It was a month ago about. And then also another part of the tokens are distributed, allocated to the ones who are working on continuing the blockchain. And for proof of work blockchains, this would be the miners, like Bitcoin. Or for proof of stake blockchains, like Ethereum, those would be the validators. And there's also one group I want to mention here, but they only very seldomly receive tokens. Those are the node operators. Those are the individuals who store a copy of the blockchain and keep it online. And now all these stakeholders have received their token, but the project want their token to be available for the general public as well. And for that, these tokens need to be listed on an exchange. There are decentralized exchanges, but I will leave them out for today as this gets a bit complicated, and centralized exchanges. And you might have heard of them like Binance, Coinbase, and FTX, which also was a centralized exchange. And for the tokens to be listed on a centralized exchange, the project needs to provide some liquidity to the exchange and also pay a listing fee for that. And then, and the good thing about centralized exchanges, or why they are popular, is because they are used as a fiat on-ramp. So for example, if one wants to exchange euros or dollars, like fiat currency, into crypto tokens, they do that via a centralized exchange. So they send money to the exchange and then buy tokens on that exchange. But what you have to notice here is when you buy tokens on the exchange, the ownership of that token is not yet stored on the blockchain. It is stored within the accounting system of that exchange. And the actual crypto tokens are still under the control of the exchange. That is why FTX was able to gamble with the customer funds, because they just accounted them to the customers, but actually they could move them and do whatever with them. So only after a user withdraws his or her crypto tokens to a wallet on chain, this is when the ownership of the tokens will be stored on chain, and then you are in full control of your tokens. And this is also what the next slide is about on-chain versus off-chain. And because there are many ways to get exposure to crypto, and very popular are these centralized exchanges as they are so easy to use. But you have to remember that they bear a high third-party risk, but they also bring you some partial utility for your coins. So on centralized exchanges, you usually can do some kind of staking or lending, so make some extra profits with your cryptos. And the next off-chain way to gain exposure to crypto, which is a bit more safe, are the traditional finance certificates, like for example from 21 Shares or FunEgg. They are certificates that are traded on normal stock exchanges, and you can buy them. And they are safe as those actors who issue these certificates are within the traditional finance system and are therefore regulated. Yet the problem with those traditional finance certificates is that they bring you absolutely no utility. You cannot stake the tokens, you cannot lend them, you cannot do any of the fun things with it. And that's why I want to advocate to you to hold your crypto on-chain. And I need to say here that it might be a bit difficult for new users to act on-chain, and you need to be aware of that and be aware and know what you're doing. Because if you're self-administering your coins, you're in full control, but you also have the full responsibility. So if you send your coins to a wrong address or interact with a faulty smart contract, then your coins might be gone in the worst case. But on the flip side, you unlock the complete utility for your coins. So you can do liquidity provision, you can do staking, and all kinds of interesting stuff that the decentralized finance system has to offer here. Okay, now we come to my favorite part, the crypto fundamental analysis. And these are the topics that I like to research when I do fundamental analysis on a crypto token. I always start my analysis with the question, what problem does this token, does this protocol solve? So what's the unique selling proposition of this? And after that, I take a look at tokenomics, because tokenomics are the most important thing for an investor to look at when evaluating a crypto project. A project can be the best project ever, but if the tokenomics are bad, it will never be a good investment. And then there are also some other topics, but I will focus on them later, because I want to start with the tokenomics as they are so important. So tokenomics, what is that? Tokenomics is short for token economics, and it basically covers everything about the token. So what kind of token is it? What is the token used for? what is the initial allocation of that token, and what is the monetary expansion of the circulating supply of this token. And at some point, you have probably asked yourself, well, those crypto guys are always talking about cryptocurrencies, crypto tokens, crypto whatever, but is there actually a difference? And yes, it is. So a token is the umbrella term for every accounting unit that is used on blockchains. So everything at first is a token. Then we have the cryptocurrency token, cryptocurrencies. They are just a subset of tokens in general. And the difference between cryptocurrencies and crypto token I will explain to you in a second. Next up, we have utility tokens. So all cryptocurrencies are utility tokens, but not all tokens are utility tokens. And there are tokens that are utility tokens and not cryptocurrencies. It gets more difficult in a second because now there come the governance tokens. So all cryptocurrencies are utility tokens. Some of them are governance tokens. And some of the utility tokens are governance tokens, but there are also some tokens that are solely governance tokens. And there are tokens that are none of like that. And because the remaining brackets are the stablecoin tokens, the non-fungible tokens, NFTs, probably have heard of funny ape pictures and stuff, and also the gamble tokens. And now I want to solve the mystery where the difference between a cryptocurrency and a crypto token is. A cryptocurrency is always the native token of a blockchain. For example, Bitcoin or Ethereum with the Ether token. And again, the technology behind that is the blockchain with the value proposal of producing block space. And block space is the amount of storage for data that every block of the blockchain has. So for example, in one block of Bitcoin, you can store 1 megabyte of data. And so basically blockchains are infrastructure for everything that builds up on top of them. Like for example, decentralized application. And these are the coins of a decentralized application, or short DApp. These decentralized application, they run via smart contract. And smart contract, that is a crypto term, but it basically means that it's just code which is stored on the blockchain, so within that block space, and it's self-executing. So if you interact with the smart contract, the code just executes. It's like a digital vending machine. You put some money in, and the product comes out. And these decentralized applications, they have very unique value proposals. So for example, there are decentralized exchanges like Uniswap, which is an example here, gaming protocols, lending protocols, or NFT protocols. And these are all built by decentralized applications on a blockchain. All right, now we come to the use cases of the token. So what are they used for? And we start with the utility token. And as the name already says, they give the owner some kind of utility for the project, for the product. So for example, Ether, the token of Ethereum, is used as a transaction fee when you want to make transactions on the Ethereum network. But there can also be utility tokens for certain other kinds of stuff, like the basic attention token, where the token is used. If you look at advertising online, you receive a token for your attention. And to evaluate utility tokens, you would have to do a demand analysis, because the utility token is connected with the usage, or the demand for the utility token is connected with the usage of that particular product or protocol. So if the usage of the protocol rises, and this should be correlated with the price of that token. Next up, there are the governance tokens, and they give the holder some kind of saying in the decentralized protocol governance. So how to move forward with the protocol. There are some, this can be voted on with such governance tokens. And to evaluate them, there's always the question, how do you price voting rights? And there are two ways. So first of all, you can do a multiple analysis. So you just compare two similar governance tokens and evaluate them. And the other thing is governance extractable value. This gets a bit more difficult, but the idea behind that is to evaluate how much money you can get out from the protocol for one voting token. And I've brought a little simplified example here for you. So think of it like this. If the project is governing a treasury, and this treasury is worth $1 billion US, and you need 50% of the voting power or 51% of the voting power to get control over that project, then 51% of the token should not be worth less than the billion that is in the treasury. Otherwise, if the 50% of the token are only worth like 500 million, then you would be able to control the value of 1 billion with only 500 million US dollars. And this is what governance extractable value tries to analyze. Next up, we have the gamble tokens, sometimes also known under the name meme coins. And those tokens have absolutely no utility. They give you no voting rights. And the only trait that they have is that they can be transferred to the next person. And those gamble tokens often have the brand identity of a popular meme. A very recent example of a gamble coin is the Pepe token. I don't know if anyone of you know Pepe the Frog, the internet meme. Yeah, maybe some of you. And this is a token that was created earlier this year. And within just 22 days, this token rose from a market cap of 0 to topping 1.6 billion. And again, this token has no utility whatsoever. It was just a simple token with the picture of a frog as brand identity. And this is why I say most parts of the crypto market are devoted to gambling. And how would you evaluate such a gamble token, as they bring no utility, no voting power? Well, you would have to do a community analysis, because the value of those tokens rises and falls with the size of the community that stands behind this project. Lastly, we have the stable coins. Those are the coins that reference the value of an external asset, like the US dollar or gold or stocks. And to evaluate them, you really need to analyze the peg mechanism so that this works out. Not like the example we have seen before of UST, where the coin was not able to hold its peg to the dollar. Now, I brought an example for you. Now we will compare 3 different cryptocurrencies and evaluate their tokenomics. And those cryptocurrencies are all utility tokens, except Aptos, it's also a governance tokens, but it's all right. They make a good basis for comparison. First, we want to analyze which parties control a major stake in this token. You can see here the token of decentralized social. And almost 80% of this token were allocated to institutional investors, the ones that invest very early into the project and therefore buy the token for a very low price. And this is a problem if a crypto project allocates such a big chunk to institutionals, because first of all, the tokens are in the hands of a few, so maybe 10 to 20 companies, owning almost 80% of the supply. And again, what is the goal of those investors? They want to make money on their investment. So earlier or later, but most often earlier, they dump the token, they sell it on the market to realize their profits. So an investor in a cryptocurrency token really would not like to invest in a token that has such a huge allocation to institutional investors. Next up, we have Aptos. The allocation here is a bit more balanced, and you can see a huge chunk goes to the community. This is a good way of how to allocate a token, because first of all, the community allocation, this is distributed to many individual wallets. So not only 10 or 20, but thousands of wallets. And secondly, community allocation are often used to incentivize the usage of the protocol. And this is also a very beneficial thing for the protocol to do. Then there is always an allocation to investors, but with 13%, that's quite all right. And then a huge chunk also goes to the foundation and the core contributors. But this allocation is also not to be worried about, as those individuals often have the long-term prosperity of the project in their mind. And on this side here, we see Ethereum, which also allocated a lot of tokens to investors. But there is a difference, and this is very crucial. Ethereum allocated the tokens to investors via an open ICO. So there are not only 10 or 20 investors who bought the token, and not only institutionals, but many thousands of wallets took part in this ICO. So they all have a small share of that token. And as they are not institutional investors, chances are that they want to hold the token for a bit longer and not immediately realize some profits. So by looking at the token allocation alone, we can already rule out one project that is not fit as an investment. And we haven't even looked at what the project do. And that's why I always start with the tokenomics when evaluating a project. Next up is the release schedule. And here you ask yourself, how much is the monetary expansion of the circulating supply? Here we see the Aptos token, for example. And the first thing we notice here, Aptos has a fixed maximum supply of 1 billion tokens. So there will only be 1 billion tokens of Aptos ever. But what we also see is that the token starts with a circulation of only 13%. So in the first year, only 130 million of those 1 billion tokens are circulating. So what does that mean for investors who buy in quite early? Well, they get very much diluted via the yearly token expansion. And this year alone, this token has an expansion rate of 68%. The year after that, 81%, and the year after that, 30%. So if you buy early into that token, you will get heavily diluted. And this is a problem. Next, we can see the release schedule of Ethereum. And the first thing to notice here is Ethereum has no fixed maximum supply. So with every block of Ethereum, there are new Ether tokens created. And you might think, so, okay, well, maybe that is a problem because then the supply is growing forever. But it's actually not the case for Ethereum, as first of all, they reduced the amount of tokens that get issued with each new block in the past few years. And also, Ethereum introduced a mechanism where coins are also taken out of the circulation. So if you do a transaction on Ethereum, you pay a small transaction fee in Ether. And part of that transaction fee is burned, so taken out of the circulating supply. So each block produces new Ether tokens, but also destroys Ether tokens from the transaction fees. And if there are enough transactions within the block, if the destroyed amount of tokens is greater than the tokens that are newly issued, then the coin can also be deflationary. And this is why currently the circulating supply of Ethereum is contracting at about 1% a year. So ask yourself, in which token would you rather invest? A token where you know in 5-10 years of time, there will be 8 times as many tokens on the market, or a token that you know, well, in 5-10 years of time, there will be less supply of this token available. And that's why, by looking at the tokenomics, we can also rule out Aptos as a beneficial investment for long-term investors. Okay, enough about the tokenomics. I think you get it now that this is the most important thing to evaluate when looking at crypto projects. Now I want to lose a few words on the remaining topics here, technology, team, ecosystem, and so on. And I really cannot go into much detail here because this would just be out of the scope. I would probably need a whole year for you to explain every detail here. But I can give you some hints that I look at, that I evaluate when doing my research. And in the technology section, you always have to differentiate if you are evaluating a cryptocurrency or a crypto token. Because when looking at a cryptocurrency, you have to evaluate the blockchain. And the most important thing about the blockchain is the consensus mechanism. So this needs to be safe and stable. Next up is the scalability. If you invest in a blockchain, you want the blockchain to have increased usage over the next years. So this blockchain should be fit to handle high amounts or increased amounts of transactions. And the upgradability of the protocol is also very important. Is it easy to upgrade the blockchain and adapt it to a changing environment? Or is it a very lengthy and time-costing process? If you look at crypto tokens, decentralized applications, you really have to take a look at the mechanics of that product. Because, for example, if you invest in some decentralized finance product, you need to know if the thing that they're trying to achieve, if the mechanics of that work out. So, example, if you see some yields in the crypto space, so for example, you see often yields about 100% a year or 1000% a year. And here you have to ask yourself, where does that yield come from? And if you don't find a satisfying answer to that, the chances are great that the yield comes from you, that you're the yield, and in the end are left with losses. Lastly, you might ask, okay, where can I find all that information? And there's always the white paper. It lays out the initial vision of a protocol, of a project. And then there is the documentation, which is a bit more updated, which explains to you every detail of how the mechanics work and how the project has evolved over the years, because the white papers today are often outdated. So the project said, okay, we want to do this and that. They achieved that, what they want to do in the white paper. Then they continue evolving from there. And this information you find in the documentation section. If you look at the team, there are always public teams and anonymous teams. And I will not say one is better than the other. But for projects with public teams, the chances that this is a scam are greatly reduced, as there are people accountable with their names for that project. And then check the background of the team. Do they have some experience? Maybe they are crypto entrepreneurs who have already launched 2 or 3 blockchain applications, or are they relatively young guys that are fresh out of university? And again, the size of the team matters. A big team can achieve a lot more than a small team, will probably take longer for developing their product. Another important thing is the ecosystem. The ecosystem refers to where is the blockchain or the blockchain application, where does it live in the cryptosphere? I mean, there are many different blockchains, but you can have the best product ever. If it is located on a blockchain that no one uses, then no one uses this project. So you really need to know, is there a vast ecosystem? Are there many users in that area of the crypto space? And evaluate that. And lastly, I always do a specific risk assessment. As every project in the cryptosphere is very unique, they also bear very specific risk vectors. And one risk that is currently relevant is the regulatory risk. So as I told you before, governments are drafting up legislation for crypto, and potentially some kinds of crypto application will be prohibited under new regulation, for example, privacy coins. Or last year, we had the example where a famous coin mixer was prohibited by the US government. A coin mixer is where you hide the origin of where the coins come from, of the transactions. As every transaction is publicly available and stored on the blockchain. But if you're a bad actor, you want to hide where you got coins from that are maybe stolen, so that no one can trace that back. And these applications, they got prohibited. Still, they exist still because you cannot stop any decentralized system from running. But if you would have invested in an application like this, wouldn't have been a great investment. All right, so now I talked to you a little bit about how to evaluate tokens and what to watch out for. Now I've brought 3 different investment styles for you that people are applying in the crypto sector. And first up, we have the crypto short-term trader. And we all have an image of a short-term trader. When you think about that, he looks like this, he probably lives in Dubai, and especially has like 10 monitors where he can monitor every trade. Drives 5 Lamborghinis and all that kind of stuff. But let me tell you, actually, the crypto trader looks like that. Why, you might ask, is because These guys are not crypto traders. They are selling stories about crypto trading. So they probably sell you some Telegram group invite or whatever. And these are the guys who actually do the trading and they lose, and that is scientifically proven. So here's a study from Taiwan which says that 80% of day traders lose money. If you don't believe me, there's another one from the US that comes to the conclusion that 66% of traders lose money and only 20% achieve market outperforming returns. And I mean, there are many of these studies, you can check them out, but they all come to the same conclusion. Short-term trading does not really work for the majority. I mean, it's like lotto. Of course, you can win in lotto, but this does not mean that the average lotto player makes money when playing. That's why I would like to advocate the passive investment strategy, as this is rather profitable compared to the short-term trader. And this is, I guess, what Warren Buffett would do if he would invest into cryptocurrencies. I mean, he doesn't, but that's his problem. And the investment thesis here is that the adoption and the usage of crypto technology will increase in the future. And I think in a world where everything is moving digitally, this is a valid investment thesis. And the strategy here is to identify fundamentally stable projects that are here in 5 or 10 years of time, or invest into the infrastructure. And again, you've heard that cryptocurrencies are a big part of the infrastructure. With rising adoption, also the infrastructure will profit from that. And the strategy here is to do some fundamental analysis, to do passive investing, and maybe do dollar cost averaging to entering your position. The horizon is very long term. Oh, what mean very long term? Well, it's more than 4 years, because 4 years is, in my experience, the average time of a crypto market cycle. This would be an example for a passive crypto portfolio. It's just simply a mixture of Bitcoin and Ethereum. Because if you mix those two coins, you have historically been given exposure to between 50 and 90% of the global crypto market cap. So it's a valid passive strategy. You only have 2 coins. And the coins that you have in your portfolio are fundamentally solid coins. You have the Bitcoin, the first cryptocurrency. It has the longest track record, probably the most widespread adoption, and in my opinion, carries the smallest risk within the crypto ecosystem. Additionally, you have Ethereum, which is the infrastructure for half of crypto today. So almost everything builds up on Ethereum. And we already talked about the tokenomics. Ethereum has very favorable tokenomics. So it has a high upside potential, and mixing those 2 coins is already a sufficient strategy and is rather easy to do. Of course, you can go for some more diversification, but there you really have to do thorough fundamental analysis to find project that will be here in 5 or 10 years of time. And I think that is not that easy, actually. Next up, we have the speculator. So these are the individuals who are going for some juicy profits. They want that 100% APR. And what they do is that they try to trade on narratives or identify early stage or mispriced crypto tokens. They do that by fundamental analysis, obviously, and also some narrative analysis. And the time frame of this investment style is much shorter. So it's between a month and a year, I would say, but it often varies. And the expectation here is to outperform the market, to make better returns than the passive strategy. I just told you the term narrative trades, and probably you don't really know what should be a narrative. And a narrative is what I've talked about before with the herd behavior. This is when everyone is flocking into an investment because they know everyone is talking about it. And narrative traders, they are the ones that are early, before the herd mentality kicks in and the other investors are joining this investment. And I have brought an example here for you. From this year, it's Ethereum staking. So Ethereum had an upgrade to the protocol in April this year. And this information was available that this upgrade will be there and that it will concern staking. And beginning in 2023, this staking narrative started, and investors started to amass coins that have something to do with Ethereum staking. And on the next slide, I will show you a chart of how that looks like. And this chart starts in 2023. These are Ethereum as the baseline comparison. And these are 3 coins that have to do something with Ethereum staking. And you see in the early weeks of 2023, this narrative takes off. So people start talking about, well, there will be this big upgrade about Ethereum staking. And then investors think, okay, if they talk a lot about it, then they're in focus, and the prices rose. Till we get about a month before the staking upgrade, this is where the early speculators have bought in, and this is where the herd mentality kicks in. So now everyone is talking about it. And the retail investors come and think, okay, yeah, staking will be live in about here. This is where the upgrade hit. I'm sure they performed real good in the beginning. I'm sure they will perform even more. But usually that's not the case. So before such an event, the prices plateau. We get into the distribution phase where the early investors then start selling again their coins. And then what you can see real good here is as soon as the upgrade hit, those coins get sold off and the narrative broke. And actually, this is contradicting itself a little bit, because after the upgrade, those projects become more valuable because only then they could deliver their use case. But again, speculators used this narrative to speculate on it and inflated the token prices of these coins. Next up, the speculator also does identifying early stage project. And the most famous example of the recent year is Polygon Matic. So it was the first sidechain scaling solution for Ethereum. And in 2020, this coin had a market cap of below 100 million. And just a year after that, Polygon became the biggest scaling solution for Ethereum and topped at a market cap of 16 billion in 2021. And how that looks like on the chart, you can see here, only a subtle difference of about 9,000% if you compare those two. So let's summarize all of this. What I want you to take home today is, first of all, always abide by the basic rules of investing. So what applies in the traditional market does also apply to some extent in the crypto markets. Then, if you evaluate a crypto token, focus on the tokenomics, because that makes or breaks an investment. Next up, for long-term investors, the fundamental analysis really is key to identifying projects and applications that are still here in a few years of time. And if you just want to gain some exposure to the crypto market, a passive strategy is, in my opinion, ideal, as it is also very easy to do. And lastly, if you're interested in speculating on the crypto market, I would advise you to be very cautious with that, because you need a lot of knowledge and need to do a lot of research. It's not some easy thing that you just find a coin and that's the next big thing. It is a big thing. It's more complicated than that. And I think you're better off with a passive strategy if you want to invest into cryptocurrencies and tokens. And yeah, that is basically it. And now you can ask me anything you like.